Welcome everyone to our Cameron Harrison webinar today on global equity strategy. For those joining us for the first time, my name is Paul Ashworth. I'm the Chief Investment Officer at Cameron Harrison. Again, I'm pleased to be joined by our Director of Investment Management and Research, David Clark.
Good to be back, Paul.
Thank you. A brief background, Cameron Harrison are private investment managers for families and private business owners. Our investment managers have been overseeing and conducting wealth management and investment management of our various individual and multi-asset classes for now over 4 decades. I think you'll agree that this is a fairly remarkable continuous track record, but significantly it highlights our experience through multiple economic and financial cycles, fads, crises and booms. Today we want to share our thoughts on global equity strategy and more particularly the global equity market and how we are positioned, particularly in light of the drive and the momentum of the FAANG stocks and technology more broadly. In this brief webinar format, we will address the macro landscape for global equities, the broad phenomena that is FAANG, being the 6 stocks of Facebook, Apple, Amazon, Alphabet, Netflix, and Microsoft. And finally, global equity strategy, the role of technology, and our approach and outlook. We'll put aside some time this afternoon for some Q&A, and through the webinar screen invite, you are there to submit your questions. Depending on your bandwidth and traffic, there can be variable quality in the screen presentation. After the webinar, you will be emailed a clean video version together with the presentation handout. As always, we're available for discussion on our investment strategies. Our purpose today and always is to be forward-looking, but cognizant that past episodes and behaviours are instructive. Having been managers for over 30 years, we are well aware that human behaviour repeats itself and that there is certain predictability about it. So let's consider the current circumstances. Is a harmful virus or pathogen new to mankind? No. Is the world and the world economy as interconnected as it ever has been? Absolutely yes. Are humans generally short-term in their focus and measurement of outcomes? Yes. Have governments around the world ever had to concurrently address a pandemic in an interconnected world? No. The first point I'd like to note that is over the medium term, COVID will eventually be addressed and managed, but probably not in the time frame most hoped for, and therefore resolution will not be a smooth line, but rather messy, at times hopelessly uncoordinated. But with each step or misstep, we learn a little bit more. We note this is not to dispel the significant short-term challenges ahead, but to provide some realism to the medium-term path ahead. As for the magic bullet of a vaccine, we noted in early May on our strategy and COVID webinar, our base case that is no effective vaccine is affected. Since then, our optimism has slightly improved, but not sufficient for us to alter our base position. This means we need to live with this coronavirus and formulate effective integrated policy, which addresses and integrates economic, health and social policies. The ability of governments around the world and with individual countries to concurrently and effectively address pandemic responses across health, social and economic policies is proving to be problematic for our government and for governments around the world. On the positive side, probably due to the experiences of the GFC, leading Western economies have responded impressively with their economic measures across monetary policy and fiscal policy. This demonstrates a learned response. We would contend that economic policy is easier to manage because the major levers of monetary policy and fiscal policy are controlled by a national government, whereas to integrate health and social policy tends to be the responsibility of state and local governments. We see this strain playing out in Australia and in the US, and in contrast is less evident in Sweden and Germany. The global economic policy response to COVID and policies of suppressions, elimination and herd immunity have been marked and impressive. by Western developed economies, but particularly the United States. This brings us to our second point. The response of central banks in concert with governments has seen both unparalleled liquidity and fiscal spending. From a liquidity perspective, we can see that money supply growth is at wartime levels. In the US alone, there are some 16 different liquidity programs on foot. This has provided financial markets with significant liquidity, and we particularly see this reflected in credit margins returning to more normal levels. The Federal Reserve has provided an all-it-takes implicit guarantee. It's a bit like surfing a wave, knowing you can't really fall off or hurt yourself. Given that there weren't really any serious build-ups in the financial system coming into COVID, this very generous liquidity provision is supportive for financial markets. Like monetary policy, the response of government spending through fiscal policy has been both rapid and warlike in size. The key point to emphasise here is the speed of policy implementation. Unlike the GFC, where government spending in the US and Euro region took over 12 months to get going, the COVID response has been rapid and gargantuan in size. This is a significant learned response, providing significant stability in household and business income, while suppression strategies are employed. We can see this in the dark green line, the massive expansion in the US deficit from 1 trillion to 3 trillion. What is also significant is the Federal Reserve has expanded its balance sheet in a similar size, largely acquiring US government treasuries. We can see the Federal Reserve's balance sheet expansion in the light green line. This is what we call an unsterilised increase in money supply, which sees the government spending financed by bonds, which the Federal Reserve is acquiring by increasing its balance sheet. This is very potent, powerful, and stimulatory for the present. We do caution, however, that whereas the Federal Reserve can create its own evergreen policies, US spending is time limited by Congress and the Senate. Getting Congress and the Senate to agree new spending, especially going into our presidential election year, is highly unlikely. Our base case is that substantial government spending will be required well into 2021, especially if rolling shutdowns in activity persist. So how does this look for global equity? In cycle-adjusted operational earnings terms, or the CAPE measure of PE valuation, equity valuations look reasonable. Yes, the short-term earnings prospects look very poor, but valuations other than the US appear to reflect this over a 2+ year basis. In the US, valuations on a cycle-adjusted basis are high. In many respects, this is partly justified for the US due to its economic growth engine, robust financial system, and household good health. That said, a more discrete dissection of the US equity market does provide a clearer picture and an insight into the FAANG market and the broader US equity market. Here we see the dichotomy between the so-called FAANG stocks, which are represented by the grey line. The price performance and valuations are significant, and David will talk more on this. In the light green line, we see the S&P 500 minus the 6 FAANG stocks. Together with other developed economy equity markets, the price performance for the broad US equity markets ex the FAANGs is much the same as the rest of the world. And as we saw in the previous slide, valuations on a cycle-adjusted basis are quite reasonable. So this brings us to the issue of investment into technology and questions like, is technology better pursued on a business-to-consumer basis or a business-to-business basis? What are reasonable valuations, and how long can price to sales valuations be justified when ultimately it is earnings and dividends to shareholders that matter in the long run? To explore these issues and our broader approach to global equities, I'm pleased to welcome David.
Thanks, Paul. US technology stocks, and in particular the FAANG or FAANG stocks, have certainly captured a lot of attention recently. And the reason is clear when you look at the performance of these companies versus the wider market. A slightly different way of viewing the performance of the FAANGs is to divide the market into 3 groups. The FAANG stocks, companies in sectors significantly impacted by COVID, so airlines, department stores, casinos, etc., and then all other companies. What the graph demonstrates is that these technology stocks have become the unlikely defensive allocation throughout the pandemic, with their value now approximately 20% higher than at the beginning of the year. In contrast, companies in shutdown exposed sectors are still 40% off their valuations. This performance has grabbed a lot of attention and headlines, but before we dive into whether to FAANG it or not, let's have a look at the drivers. In our opinion, the rally is really a combination of the following factors. First, at a visual level, it seems that these companies are immune from the impacts of the COVID-19 related shutdowns. As people settle into a life structured around greater time indoors and at home, consumer technologies, streaming and delivery occupy a greater proportion of our attention. As a result, many investors are using these companies as a proxy for the stay-at-home economy. Second, we're seeing rates slashed to near zero or below. In the bull market preceding the pandemic, it was common to hear market commentators say that risk assets have re-rated due to falling interest rates. Whilst this is true for bonds and other assets with very stable, resilient cash flows, for example, residential property or utilities, at an aggregate level, this has not been the case for equities. As this chart demonstrates, we have the average equity market yield in the dark green and the bond yield in light green. We've seen the yield on bonds steadily fall from one cycle to the next as bond prices have risen. We do not see the same trend for global equities as a whole. The reason being that the economic conditions that produce low rates are also seen as headwinds for corporate earnings. Now, there is one exception to this, and it is the third reason behind the performance of the FAANG stocks, and it's secular growth. By this I mean earnings growth that is independent of wider economic conditions. For the moment, the market believes that earnings of these companies will continue to grow regardless of the economic cycle, with the inherent thinking that no matter what the shutdown looks like, we will continue browsing Facebook on our iPhones while also watching Netflix and Googling everything we need to have delivered the next day through Amazon Prime. It goes without saying that we believe the danger lies in this assumption. Now, there's a fourth reason that I want to touch on, and that is the increased activity of retail investors since the start of this crisis, with retail account openings running at 3 to 4 times the normal rate. The exact reason for the increase in retail activity is not precisely known, but is likely a combination of just more time at home on a computer, the rise of brokerage-free trading through companies such as Robinhood, and finally, just a case of more time on people's hands. Although not strictly a FAANG or FAANG or technology stock, Tesla, the car maker, helps to illustrate some of the irrational exuberance that's crept into the trading of these stocks. So Tesla's share price is now double what it was at the start of the year, and it trades on a PE ratio of 10,000 times earnings, compared to a market average of a little over 22. The company's valuation is now greater than many established car companies, including General Motors, Ford, Fiat Chrysler, Ferrari, Honda, and Hyundai. And I'm not just talking about being more valuable than any one of these in particular. Tesla is now more valuable than all 6 of these companies combined. It is interesting when you overlay the trading in this company through Robinhood, which is largely retail investors, which is the grey line on this chart, with the share price in green. You see a striking correlation. Now, this phenomenon is not just restricted to Tesla. In the table on the left-hand side, you'll see the highest 14 companies in terms of number of investors on Robinhood. It appears that this retail market is infatuated with companies that have been in shutdown sectors, such as airlines or cruise ships, that have been in the news a lot and have the potential for a quick or big recovery, and also companies that they use on a day-to-day basis, so technology, Facebook, Amazon, GoPro, and even a cannabis company. These appear all to be top-down driven investment approaches that, in our opinion, have seen valuations diverge from fundamentals. So why aren't we buying the hype? Well, firstly, as I alluded to in the previous section, no man is an island and neither is a company. This idea that tech companies can operate in a bubble and deliver earnings growth while the rest of the economy is in recession is fanciful. Many of the FAANGs are vulnerable to the same headwinds as other less fancy sectors. For example, a slashing of advertising, as happens in most recessions, would directly impact Google and Facebook. In a similar vein, it seems probable that computer acquisition budgets will get slashed, as will appetite of consumers to upgrade to the latest and greatest iPhone, extending the phone cycle times. Further, at the current valuations, we view these companies as vulnerable and expensive, particularly given the potential for regulatory intervention. Not that long ago, we were talking about breaking up big tech, but also in terms of PE ratios, which are at least 40% higher than the market average. Finally, it's worth remembering that tech is more prone to disruption than other sectors. If you were to look at the 10 largest cap tech stocks at the peak of the tech bubble, all 10 of them have since underperformed the market. So investors need to be very careful in extrapolating the current conditions over the next 5 or 10 years. So if not FAANG, then what? Well, technology still represents over 20% of our US investment. It's just not in the high profile companies. When we look at technology companies, we like to split them into 3 categories. Business to consumer, which would be your Apple and Facebook and Netflix. Business to business, which would be Microsoft and Amazon, and then industrial technology. In the B2C segment, history is littered with companies such as Kodak, Sony, or even Nintendo that have dominated with consumers for a period of time, but eventually found it difficult to maintain the levels of innovation and creative destruction required to capture the eye of consumers, who tend to be more fickle and quicker to transition to the latest thing than business consumers. In particular, what you see is it's very difficult to dominate through different technology paradigms. For example, the move from business computers to PCs to mobiles, or from VCR to DVD to streaming. Each of these paradigm shifts has seen the emergence of a new dominant player. On the other hand, we do tend to like companies in the industrial technology area. That is, a technology that is aligned with a specific industry or niche and has an established end-use case. A couple of examples in our portfolio currently would be Honeywell, which provide automation and control technology, Broadridge Financial, which is communications and analytics for financial services, and even a more recent addition, IBM, which is data, cloud, and artificial intelligence for corporations. Part of the reason why we like this area is they offer more established players with higher barriers to entry for the competition. They also have a clearly defined and addressable market, so are less likely to get disrupted. The other point worth making is whilst technology has gained a lot of attention recently, it is not the only game in town. I've extracted from our US portfolio our consumer staples holdings, so Walmart, Procter & Gamble, healthcare, Amgen, which is a drug manufacturer, Abbott Laboratories, and Johnson & Johnson, and our consumer discretionary, Home Depot, which is like a US Bunnings, and Best Buy, which is a consumer electronics retailer. These companies comprise over half of our portfolio, and if you look at their performance in this chart, you see that they've been able to deliver over 10% gain for the year so far. And this is all based on improved profitability and not just sentiment from the retail market. They also have materially lower price earnings ratios and less scope for the formation of bubbles. I'd like to finish by making 2 points. Firstly, within our US equity strategy, we are seeking to provide a diverse exposure to quality companies. Often this is in industries that are underrepresented in Australia or are priced at a premium, such as healthcare. As a result, the portfolio has no banks and no mining exposure. We're not here to make thematic bets, and as demonstrated by the broadly even allocation across technology, staples, healthcare, consumer discretionary, and industrials in the pie chart below. Second, within these sectors, there are quality companies that are more reasonably priced, and as a result, have a better balance of risk assessment for future returns. So finally, to answer the title of this webinar, to FAANG it or not, as Paul noted in his slides, at elevated valuations, if you choose to FAANG it, I think you're in for a wild ride.
Thanks, David. So as we said at the outset, we invited questions for So in terms of questions, we've got a few questions. The first one was, are there any FAANG stocks you could invest in going forward? Maybe David, if you'd like to touch on that.
Sure, Paul. It's a good question. I often think of the FAANG acronym being a bit like the old BRIC acronym, which grouped together Brazil, Russia, India, and China as emerging economies, and it proved in the end that that wasn't a particularly good grouping because they were all quite different countries. And similarly, the FAANGs, although they're all US technology stocks, they're all quite different amongst themselves. So if I was to pick two, I'd probably pick the ones more aligned to a business-to-business sector. So that would probably be Microsoft and also Amazon. In terms of Microsoft, software division is moving towards a monopoly state at the moment. And in terms of Amazon, we look quite favourably on the cloud business, which they've developed really to support their e-commerce. It is now the division that makes all the profit for Amazon. So if there was to be a split out of Amazon into that cloud area, which Microsoft is also quite strong on, that would be two that we'd be quite interested in.
Great. Okay, another question that's been asked is, if a credible vaccine or treatment is developed, how do you think financial markets will adjust? I suppose there'd be 3 points that we'd note. The first would be if there were credible therapeutic treatment or vaccine, we would likely start to see a significant reversion back to normalised economic conditions. I think that would challenge policymakers in their ability, both as to size and timing, of reversing their stimulus programs. And we saw through and after the the GFC period, that it was a real challenge for the Federal Reserve to reduce its balance sheet and to be able to increase its interest rates. And it became a real tug of war between the Federal Reserve and bond markets and equity markets. So the net of that would be a lot more financial or a lot of volatility for financial markets. I suppose the second point we would note is the markets have become rather comfortable with the liquidity programs that have been put in place, and kind of think of it like a buffer, for the next 18 to 24 months. So if there was a vaccine or significant therapeutic treatment, and that arrived a whole lot earlier, that would likewise change the assumption of financial markets and provide probably quite a lot of volatility. And then probably the third thing, which is probably not a bad thing, given the nature of our approach to global equity strategy, is a substantial uplift in economic growth would favour more of the traditional cyclicals as opposed to a number of the FAANG stocks. So that probably, in the net of all of that, a return to normalised conditions would probably prove good for the real economy, but would probably prove quite problematic for financial markets and bond markets. Well, I think there are questions that have come through. We, as always, thank everyone for their time and attention, and most importantly, their support. Today's in Melbourne, and first day of wearing masks. So had we asked ourselves 6 months ago, would have this been the world we're living in? Well, of course, absolutely not. So we wish everyone well. We're, of course, always available to discuss any element, in this case, particularly in terms of global equity strategy. We wish you well and hope that you keep safe, and please keep in contact. Thank you for joining us today.